Hello, everybody. My name is Patrick Kavamba, and I'm the Managing Director, founder of Kavamba Advisory Services, a management consultancy services provider. Now, we're going to be discussing board oversight on anti-money laundering risk systems for commercial banks. Let us proceed. Now, first of all, about Kavamba Advisory Services Limited, our management consultancy services practice has provided, we have a track record on providing AML advisory to commercial banks, to central banks, as a matter of fact. And what you see down below is what some of our clients had to say about our firm in terms of the AML advisory that we provided to these institutions. As for me, I am founder and managing director of the firm. I have led over 20 short-term expert assignments and technical assistant projects on AML. I'm a former bank examiner with the Bank of Zambia. Of course, I completed the AML School of the Board of Governors of the Federal Reserve System in Washington, D.C. I also completed the specialized course in banking supervision at the Federal Reserve Bank of New York. I've done other trainings and so on and so forth. I am author of the Anti-Money Laundering and Know Your Customer book. It's a short guide to the bank's customer due diligence. It's on the Amazon platform if you wish to purchase that. Now, our discussion is going to constitute 5 modules. We'll walk through the introduction, AML risk governance, the AML risk strategy, and the risk management itself in terms of measuring the risk, in terms of mitigating the risk and monitoring the risk itself, the AML risk per se. And then we'll talk about suspicious transaction reporting. Now, as for the introductory part, what is money laundering? Money laundering, as a matter of fact, constitutes 2 crimes. The first crime, what is called the predicate crime, is usually a criminal offense. A criminal offense from which somebody generates funds, generates money. Now, that money, supposedly dirty money, supposedly so now you have that money from the predicate crime, and then you introduce this money into the financial system. So what is the financial system, one may ask? The financial system constitutes of institutions, constitutes of the rules that govern those institutions. So what is money laundering is actually having these ill-gotten gains and introducing them in the financial system. You may want to place that money into a bank account. You may want to use financial institutions to transfer that money. And you may want to remove that money from the financial system and actually make purchases of assets. The purchasing of assets is what we refer to as integration. The introduction of that money is the process of actually the depositing of ill-gotten gains into the financial system is what we refer to as the placement process of money laundering. Now, you can want to move money around, moving money from one account to another through fictitious transactions, so as to obscure the origins of the funds. And this is what we refer to as layering. So money laundering constitutes 3 processes, namely placement, layering, and integration. And these processes can happen all at the same time. They may not need to happen one at a time. That is what money laundering is. Now, predicate offenses, where we sought these predicate offenses from the European AML directives document, you will see that the EU mentions 22 predicate offenses, including corruption, fraud, terrorism, and an array of offenses from which perpetrators of crime can generate finance or can generate money and use the financial system to benefit from that money. As far as the regulatory framework for anti-money laundering is concerned, we have laws enacted by the legislature. In almost every jurisdiction, you have laws enacted by the legislature on money laundering. But we have designated government agencies that are the administrators of that law, usually referred to as financial intelligence units. Now, these guys, the financial intelligence units, they collect and analyze information about financial transactions in order to combat money laundering, terrorist financing, and arms proliferation. We also have the banking regulators that ensure that the regulated entities have adequate systems, to manage the risk exposure from the law. Now, with respect to the the voluntary international regulatory frameworks, we have the Financial Action Task Force, which is an intergovernmental body that establishes and promulgates best practices, international best practices on AML. We have the Basel Committee on Banking Supervision, also that sort of also have, they set standards for banks to follow with respect to managing AML risk. We have the Wolfsburg Group, which is an association of 11 global banks. Also, these guys assist in coming up with international best practices for managing AML risk. Now, we have regional bodies, for example, such as the East and Southern Africa Anti-Money Laundering Group, which is a regional body that works hand in hand with the Financial Action Task Force. Now, this is an East and Southern Africa group. We have other groups in Asia, in the Americas, and so on and so forth. So these are voluntary institutions which you can adhere to the recommendations of the Financial Action Task Force, of the Basel Committee, of the Wolfsburg Group. Now, that is what money laundering is. And money laundering is a risk to the bank because the bank stands to lose money through fines if the bank is not adhering to the laws. The bank stands to lose reputation if the bank is failing to sort of set up systems to design, to administer, and to implement anti-money laundering systems. Because the question is, if the bank is failing to handle this aspect of risk, what other aspects of banking risks is the bank failing to adhere to? You wouldn't want to keep your money in a bank that is failing in one area of risk. I mean, a bank has got to be up to scratch with the entire risk framework of the institutions, the enterprise risk framework of the institutions, as we shall see as we go. Now, let us speak about risk governance. By AML risk governance, anti-money laundering risk governance, what we mean is the role of the board and senior management of the bank. Now, the anti-money laundering risk system cycle is a 5-step process, meaning the bank, the board of directors and senior management are responsible for account opening procedures. They are responsible for identity verification procedures, for customer risk assessment procedures, for surveillance of transactions on the customers that are deemed high risk or moderate risk, or even, as a matter of fact, low risk customers, as well as suspicious transaction reporting to financial intelligence units. Now, the first 3 steps, account opening procedures, identity verification procedures, and customer risk assessment procedures, these 3 steps are what are referred to as KYC, or Know Your Customer. Largely, a bank is expected to have a KYC policy. By account opening procedures, what we mean is that the bank, the board of directors, must ensure that when a customer is being onboarded, when a prospective customer is coming to join the bank as an account holder, the account opening procedures entails collecting relevant data from the customer that enables the bank to understand or to know the customer, to form a reasonable belief that the bank knows who the customer is. Identity verification procedures are procedures that entail the bank verifying the identity of the customer. So the customer is going to have to bring the identity card, identity documents to the bank. The information contained on the identity, the bank has to verify with the identity issuing authorities whether that information is actually true. So these procedures must be enshrined in the policy of the bank. Now we also have customer risk assessment procedures. Now with this, the risk assessment procedures, this is about measuring the likelihood of the customer in terms of the likelihood of the customer engaging in illicit activities or perpetrating the crime of money laundering. We shall look at this as we go down. Now, with automated surveillance, the board and senior management is responsible for providing the tools in the bank required to monitor suspicious transactions. Now, some of the customers are going to be deemed high-risk customers in terms of money laundering. There has to be systems in the bank adequate enough to monitor suspicious transactions emanating from high-risk customers. Tools adequate enough to monitor suspicious transactions from moderate risk customers and from low risk customers. And ultimately, the banks need to have policies, procedures, and processes for reporting suspicious transactions. Mind you, the bank is not, we are not law enforcement agencies. What we have to do is to report to financial intelligence units, and financial intelligence units is the responsibility of the financial intelligence units to conduct further investigations and establish whether actually money laundering is being perpetrated or not. Now, the role of the board and senior management through the lens of the financial intelligence units may somewhat differ from the banking regulators. Through the lens of the financial intelligence units, what is required of the bank is essentially four things. The bank must have an adequate compliance program or an adequate compliance policy that has four components. The first component is internal controls. What we mean by internal controls essentially is KYC, Know Your Customer policy. We shall talk about implementing the Know Your Customer policy when we go as we go down. Now, the bank also must have must conduct independent audit on AML risk systems and practices. The bank must, the board and senior management must designate an AML compliance officer, and there has to be ongoing AML training. Now, also, what we have here is that the bank must establish three lines of defense. The first line of defense, meaning internal controls themselves in the business units. The bank must have second line of defense, meaning that there has to be the AML compliance officer ensuring laws. Now, with my country, Zambia, this is enshrined in Section 23 of the Financial Intelligence Center Act of the Laws of Zambia. In terms of first line of defense, second line of defense, and third line of defense systems in the bank. The third line of defense is the internal audit. If you saw earlier, if we go back, we see that independent audit on AML risk systems and practices is part of the components of the AML risk. Now, through the lens of the banking regulators, essentially, the banking regulators will look at what we call Pillar 1 risks, Pillar 2 risks, and Pillar 3 risks. Now, AML risk is a Pillar 2 risk, and what the banking regulator will want to see is And what pillar 2 is actually supervisory review, okay, and evaluation of the bank's risk systems. Now, the banking regulators will carry out a supervisory review in terms of how the bank is managing all other risks that are not capital related. Pillar 1 risks are capital related risks, as in we use credit risk assets, market risk assets, and we use operational risk to measure to measure the capital of the bank. Now, in most jurisdictions, like in my country, Zambia, what we have is that credit risk, market risk, and operational risk measurements of capital must be at least 10% of risk-weighted assets. But we're talking of pillar 2 risks in terms of AML risks. So the bank is going to have to report to the banking regulator in terms of how it's managing liquidity risk, strategic risk, compliance risk, reputational risk, model risk, climate risk, and all these other risks. Now, there are capital buffers and counter-cyclical, such as the counter-cyclical buffer. I mean, from the minimum capital, the minimum capital requirements, say 10% of risk-weighted assets, we are going to add more percentages, such as 2.5%, such as 4%, and so on and so on, for buffers that should sort of compensate or take care of all these other risks that are pillar 2 risks. Now, we also have pillar 3 risks, meaning that there is reporting risk. A bank must report, okay? A bank must disclose. We call this market disclosure. So the bank must disclose to stakeholders in terms of how it's managing all the risks in the bank. Now, this report is sometimes referred to as pillar 3 report. It's sometimes referred to as the risk disclosure report. It is sometimes referred to as the internal capital adequacy assessment process report. So the reporting of how the bank is managing the anti-money laundering risk in terms of all the way from the risk management cycle, beginning from risk appetite statement, risk policies and processes, measurement methodologies, risk language, and so on and so forth. This has got to be disclosed in this report, and there is a risk that the bank may not adequately disclose how the bank is managing AML risk in the bank, and this is what we refer to as the reporting risk. Through the length of the banking regulator, the bank must have a business plan on top there, in terms of the vision, articulating the vision and the strategy of the bank. The bank is in the business of managing risk, and therefore the risk culture must be embedded in the entire bank structure. Now, when we say enterprise risk management framework, what we mean is the bank must have a structure for risk governance. Now, here we mean the role and responsibilities of the board must be articulated in the board charter. It must be articulated in the risk committee charter. Must be articulated in the audit committee charter in terms of how the board is going to manage AML risk. In terms of the role of the board in managing anti-money laundering risk. Now, also, we have the risk appetite statement as part of the enterprise risk management framework of the bank. The bank must have a risk appetite statement for each and every risk, including AML risk that the bank is facing. Now, we measure risk in terms of low, moderate, or high. So excuse me.